I need you to cancel your plans. I need you to stop what you're doing right now and focus. I need you to understand that while you were sleeping last night, while you were thinking about your weekend activities, the informational backbone of Western finance experienced a catastrophic disruption. It did not collapse in a spectacular fireball that would make the evening news. It did not announce its death with sirens blaring and headlines screaming. It simply went silent. It flickered and went dark. And in the world of real-time settlement systems, in the universe of high-frequency trading and instantaneous reconciliation, silence is not peace. Silence is not a technical pause. Silence is absolute terror. Silence means the numbers stopped adding up somewhere deep in the machinery, and somebody, somewhere, made the decision to pull the emergency brake and hide the wreckage from public view. Ladies and gentlemen, this is the Asian Guy. It is Saturday, January 31st, 2026. The trading desks on Wall Street are empty. The floor brokers have clocked out and gone home to their families. The screens are frozen. The markets are officially closed. This is supposed to be the dead zone of global finance, the boring, uneventful 48 hours when the machines run their automated reconciliation processes and the clearinghouses settle the accumulated trades from the week. It is the time when the financial plumbing does its invisible job in the background without anyone paying attention. But today, right now, the plumbing is not just clogged. The pipes have catastrophically burst. And what is leaking out onto the floor is not water. It is the toxic secret that the entire precious metals market, the backbone of hard asset wealth, has been running on fumes and falsified records for longer than anyone in a position of authority wants to publicly admit. We have been monitoring the data streams from the CME group, the Chicago Mercantile Exchange, for the past 6 hours straight. This is the most critical price discovery mechanism on planet Earth. This is where the world determines what gold costs, what silver costs, what the fundamental value of hard assets should be. And for the last 6 hours, we have been repeatedly attempting to pull the daily delivery reports. We have been trying desperately to access the issues and stops data, the sacred document that tells us exactly who demanded physical metal and who actually received those bars into their vaults. This is not optional information. This is the foundational data that proves the system is functioning. And what are we getting back from this supposedly infallible CME infrastructure? We are getting blank fields where numbers should be. We are getting outdated timestamps that make no sense. We are getting cryptic error messages. We are getting a digital void, an information black hole precisely where there should be mountains of verified, time-stamped, legally binding transaction records. Do you believe in accidents? Do you honestly, genuinely believe that the most heavily funded, most redundant, most obsessively secured financial infrastructure in human history just happens to experience a catastrophic reporting failure on the exact same weekend that silver prices suffered a 26% intraday crash from their recent highs? Do you believe timing like this is pure coincidence? Because I do not believe in accidents. I do not believe in coincidences of this magnitude. I believe in cover-ups. I believe in controlled demolitions designed to hide evidence. And what we are witnessing right now is the digital fingerprint of the largest precious metals fraud in modern history being hastily erased before Monday's opening bell. Let me explain in detail what is missing, because this is critical. Every single trading day without exception, the CME publishes two fundamental data sets that form the bedrock of market transparency. First is volume, which tells us how many contracts changed hands during the session. Buyer met seller, transaction completed, money exchanged. Simple arithmetic that anyone can verify. Second is issues and stops, which tells us how many of those paper contracts actually converted into physical metal leaving the warehouse. How many traders looked at their contract and said, "I do not want your promise anymore. I want the actual bar delivered to my vault." These two numbers must reconcile perfectly. The mathematics must balance to the ounce. If 1,000 people stood for delivery and demanded metal, then the report must show exactly 1,000 issuance notices. No exceptions, no rounding errors. But for 14 consecutive trading days leading up to this weekend, we have been watching something that should be mathematically impossible unfold before our eyes. We have been seeing volume data that suggests absolutely massive, unprecedented delivery demand. We have been seeing open interest numbers that imply tens of millions of ounces moving from paper promises into physical custody. But the issues and stops report shows either nothing at all or numbers so absurdly, impossibly low that they violate the fundamental laws of market mechanics. And today, the climax, the report simply froze. It did not update. It did not publish. The CME called it technical reporting issues. That is corporate language. That is the carefully chosen phrase you use when you cannot publicly say, "We have lost complete control of the ledger and we no longer know who owns what metal or where it is." You might think it is just a software bug. But the CME spends billions on redundancy systems, backup servers, and cybersecurity that would make intelligence agencies jealous. It does not just have a glitch, especially not on the weekend of a 2 million ounce delivery cycle in the middle of the most violent price dislocation in precious metals history. This is not incompetence. This is concealment. And to understand what they are concealing, you have to look beyond the sanitized official press releases. You have to look past the bland corporate statements. You have to look at the whispers circulating in the intelligence sector, the encrypted conversations happening on secure channels, about a state-sponsored hacking collective known by the codename Salt Typhoon that has been methodically infiltrating American critical infrastructure for months. Not just the telecom grids or water facilities, not just the obvious targets that make headlines, the financial settlement layer, the beating heart of the system. Here is the theory that is surfacing on encrypted channels where the real analysts operate, the ones without corporate masters to appease. What if Salt Typhoon did not hack the CME to destroy it in some dramatic, headline-grabbing cyber attack? What if they infiltrated it to systematically drain it of physical assets? Think about the strategic brilliance. You penetrate the matching algorithm, the core code that determines which buy order gets matched with which sell order in the queue. You insert a ghost protocol, an invisible subroutine that silently prioritizes your delivery orders above everyone else's. You extract physical metal from registered vaults, bar by bar, and move it into accounts controlled by shell entities with anonymous ownership structures. But simultaneously, you suppress the reporting mechanisms. You manipulate the data feed so the vault inventory numbers look stable, look normal, while you're actually bleeding the system dry. The security cameras play a loop, showing business as usual while you load the trucks in back and drive away with the treasure. This explains the glitch. The CME cannot publish accurate reports because when they reconcile the database with physical reality, the numbers do not match. The computer says 50 tons of gold should be in the registered category, but the actual vault count found significantly less. The algorithm is crashing because the map no longer matches the territory. They cannot publish the report. If they show the sudden, unexplained vanishing of eligible inventory, it will trigger an instantaneous global bank run. So they declare technical issues, they buy 48 hours to either locate the missing metal, fabricate ledger entries, or beg the Federal Reserve for an emergency bailout. But while they scramble, the market is already smelling blood. When a clearinghouse hides its numbers, it means the clearinghouse is insolvent. And the proof this is structural fracture rather than a simple error is visible in the price chaos. The spread between gold in Mumbai and gold in New York has exploded to $283. That is not a spread. That is a canyon. That is the market screaming that the bridge between the paper market in New York and the physical market in Asia has been severed. We need to understand this spread. We need to examine why arbitrage has died. And we need to prepare for what happens on Monday morning when the world wakes up to the realization that the global price of precious metals no longer exists. There is only a New York price and an Asia price, and they are no longer speaking to each other. For 90 days, the cybersecurity industry has been on fire with warnings about massive infiltration of American infrastructure. Water systems, broadband networks, power grids. The media called it prepositioning, planting logic bombs to shut down electricity if war broke out. But analysts missed the real target, the settlement layer, the financial nervous system processing trillions in assets daily. Here is the nightmare scenario terrifying Wall Street this weekend. What if the CME blackout is not malfunction, but deliberate feature? What if Salt Typhoon breached the exchange, not to destroy it, but to loot it from inside? The rumor is hackers compromised the delivery notice algorithm. They created a backdoor that allowed them to issue legitimate delivery demands for physical bullion while suppressing reporting to risk oversight systems. They told the vault to release gold bars, but told the surveillance system nothing had moved. For 2 weeks, while data showed minor irregularities most ignored, staggering quantities of bullion were quietly retitled into private shadow accounts controlled by offshore shell companies. They drained the reservoir while the gauge showed full. This is why the CME went dark today. They likely ran a physical inventory audit and discovered the spreadsheet did not match reality. The computer said 5 million ounces of gold. The actual shelf count came up catastrophically short. The technical issue is the cover story while they desperately figure out where the metal went. They shut down public reporting because publishing actual numbers showing sudden multi-million ounce discrepancy would detonate global panic. So they pulled the plug. They bought themselves a weekend to find the missing metal or construct a plausible lie. And why would a foreign power risk such brazen economic warfare? Because this is already war. If the United States deploys financial weapons to destabilize rival economies through currency manipulation and tariff pressure, the adversary needs asymmetric counterstrike. Draining the COMEX is that weapon. By stealing the physical collateral underpinning Western financial architecture, they force a default and prove the emperor of dollars has no clothes. This recontextualizes everything. The $283 spread is not just inefficiency, it is the market pricing in the theft. Sophisticated money knows the metal is gone. They know registered inventory numbers are fabricated. Every paper contract trading in New York is now backed by nothing. Claims on a raided vault. The cyber conflict evolved from stealing information to stealing atoms. If this theory proves accurate, Monday morning is not a volatility event. It is a crime scene investigation. And that brings us to the mathematics. Mathematics does not care about press releases or technical difficulties. Mathematics only cares about equality. And right now, the fundamental equation holding the financial system together, the equation saying price in location A must equal price in location B, has returned an error. We are staring at a $283 divergence that should not exist in any functioning market. Let me show you the scoreboard as of Saturday evening. After hours, electronic desks and physical bullion networks are still quoting prices. The divergence widens every hour. In New York, the paper price of gold hovers around $5,200 per ounce. But in Mumbai, the physical price, the actual cost to hold a kilogram bar, trades at $5,483. Subtract those, $283. In a normal functioning market, we have high-frequency trading firms, massive institutions that invest hundreds of millions of dollars to lay dedicated fiber optic cables across entire oceans just to reduce their data transmission latency by 3 milliseconds. 0.003 of a second. That is how competitive this game is. They operate sophisticated arbitrage bots, automated algorithms that scan global exchanges constantly, 24 hours a day, 7 days a week, hunting relentlessly for any price discrepancies they can exploit. If gold is even 1 penny cheaper in New York than it is in Mumbai, the bot instantly, faster than you can blink, buys in New York and sells in Mumbai. It captures that 1 penny of profit with zero risk, pure arbitrage. It executes this exact trade millions of times per day, billions of dollars in volume. It is literally free money. It is risk-free profit harvesting at industrial scale. So if there is a $283 difference sitting wide open in the market, exposed for everyone to see, what should theoretically happen in a healthy system? Every single algorithm on the planet should be screaming bloody murder. Every hedge fund, every proprietary trading desk, every quantitative shop should be backing up the proverbial truck. They should be buying New York gold with maximum leverage and selling it in Mumbai until the price differential snaps shut like a rubber band. The spread should collapse in seconds, maybe minutes at most if the systems are slow. But it has not collapsed. It has been sitting there, gaping open for 6 consecutive hours now, staring at us, mocking us. Why? Why is nobody picking up the $283 bill that is lying on the sidewalk in broad daylight? Only one explanation. You cannot move the metal. Arbitrage requires 2 steps. Buy the cheap paper contract in New York. Stand for delivery, take possession, ship to Mumbai, and sell for higher price. Algorithms attempt step 1. They slam into a wall at step 2. The computers know if they purchase the New York contract, they will never receive the gold. They understand technical issues means insolvency. You cannot complete the arbitrage. The bots have been switched off. Liquidity providers evaluated non-delivery risk and determined it is infinite. Arbitrage is dead. When arbitrage dies, the global market dies. We no longer have unified global price for gold. We have a New York price, fictional, and a Mumbai price, real. The United States market has become an isolated island, and this is not limited to gold. Examine silver. The spread between London spot and Hong Kong physical has exploded to $13 per ounce, more than 10% of base price. Under normal conditions, the spread is 10 cents. $13 is apocalyptic. The metal is physically trapped. Silver in Hong Kong is hoarded behind an impenetrable barrier. The flow is stopped. Velocity of capital hit 0. This is systemic cardiac arrest. The blood, liquidity, no longer pumps to the extremities, the exchanges. When blood stops flowing, tissue dies. We are watching the death of the paper pricing mechanism in real time. The $283 gap is the insolvency premium. The market charging you enormous fees to compensate for risk that the United States financial system is genuinely bankrupt. But why now? Why did arbitrage break today? Why is metal trapped in Hong Kong? This is legal warfare. We need to examine the justification Asian banking institutions use to prevent metal movement. We need to discuss Hong Kong and a new regulation effective January 1st, granting authorities power to lock vaults under cybersecurity pretexts. The reporting blackout in Chicago is only half the trap. To understand why arbitrage is dead, why the $283 spread refuses to close, examine the other side, Hong Kong. While the CME is dark due to technical issues, major bullion banks in Hong Kong suddenly decided this weekend, mid-global liquidity crisis, is perfect for system upgrades. Reports from Asian traders confirm HSBC Hong Kong and several major custodial vault operators effectively froze operations. Attempt to withdraw physical silver today? Request denied. Try to allocate gold bars for international export. System shows pending indefinitely. Official explanation is emergency cybersecurity maintenance and compliance updates. Sounds mundane, routine procedure, but this is not maintenance. This is financial siege. We need to examine legislation that slipped beneath the radar but has become the most powerful document in global finance. The Protection of Critical Infrastructure Ordinance. Full enforcement January 1st, 2026. Grants government authorities sweeping emergency powers to seize control, shut down, or freeze any system classified as critical infrastructure during declared cybersecurity threats. What qualifies? Financial clearing systems, precious metals vault networks, digital settlement layers, connect the sequence, cyber attack allegedly by Salt Typhoon strikes United States financial system, CME goes dark. Authorities in Hong Kong declare elevated threat levels citing global cyber instability. They invoke the ordinance, instruct banks to lock down, no digital transfers, no physical movements, claim they need comprehensive audits to ensure no malicious code penetrated vault management software. Perfect legal camouflage. Not defaulting, not announcing we lack silver that triggers panic and bank runs. Instead, claiming we are protecting you, securing against foreign hackers. Just pausing withdrawals for malware scans. Brilliant. Stops the hemorrhaging without admitting they are bleeding. China effectively nationalizes every ounce of silver in Hong Kong facilities. Metal checks in, does not check out. Financial roach motel. This is why the spread is $13. Market understands silver in Hong Kong is trapped behind digital iron curtain. London traders scream for physical supply, willing to pay premiums. Hong Kong vault managers point to screens displaying system lockdown, shrug helplessly. Cannot open the door. Government requires malware completion first. Meanwhile, metal is quietly retitled from Western custodial ownership into Eastern strategic reserves, while surveillance is offline. Timing undeniable. United States reporting goes dark. Same weekend, Hong Kong implements vault lockdowns. Coordinated pincer movement. West conceals empty vaults by shutting transparency. East locks gates on accumulated hoard. Trapped in middle is global supply chain, suffocating. No liquidity, no flow. Overnight transition from just-in-time delivery to just-in-case hoarding. Consider Monday implications. Short sellers, hedge funds wagering against silver, experiencing absolute terror. To close short positions, to exit, need to deliver physical metal or buy contracts back. But where to acquire metal? Cannot source from CME. They lost data and probably inventory. Cannot source from Hong Kong under emergency maintenance. Trapped inside burning structure with no exits, pressure building with no release valve. Since no physical mechanism to equalize price, only variable that can adjust is paper price. Must move vertically to reflect asset has become unobtainable. We are staring at potential force majeure declaration. Legal terminology for act of God. Clause in commodity contracts stating if we cannot deliver metal due to unforeseen circumstances like cyber attack, we are not obligated. Simply pay cash settlement instead. But what price? Fraudulent New York price of $5,200? Or authentic Mumbai price of $5,483? Litigation over settlement price will be bloodiest legal war in financial history. Commences when opening bell rings Monday. $283 spread. Shattered reporting system. Operational shutdown in largest physical hub in Asia. Market waking to horrifying realization the hack was not accident. It was opening move of a reset. What happens when electronic markets resume Sunday night? When algorithms comprehend liquidity reached absolute zero? We need to forecast, prepare for violent repricing. This brings us to moment of impact. Currently sitting in hurricane eye, Saturday night. Markets frozen, screen static. CME website displaying reporting errors. Hong Kong vaults locked for maintenance, but clock advances. In less than 24 hours, when sun rises over Wellington, an electronic Globex session initiates for Sunday night, the financial world unpauses. And when it unpauses, will not resume from where it stopped. It will snap like overstretched rubber band. Understand blocked market physics. Normally, financial pressure releases gradually. Prices drift up, arbitrageurs sell, prices drift down. Functions like steam valve releasing incrementally. But now, valve welded shut, $283 spread on gold, $13 spread on silver. Broken ledger in Chicago, locked vaults in Hong Kong. No remaining mechanism to equalize pressure, so when market opens, price cannot drift higher gradually, it must teleport. My prediction for Sunday night is straightforward and terrifying. Violent repricing event. Genuine possibility of silver gapping up $20 in first 10 minutes. Not 20 cents. $20. Why? First trade will not be speculation. We'll be covering panic. Imagine you manage hedge fund short 500 silver contracts. Left Friday confident because price crashed to 90. Then weekend, saw CME data vanish, Hong Kong lockdowns, spread explosion. Realized you are short an asset that does not exist in available supply. Must cover immediately or face forced delivery of metal you cannot purchase at any price. Opening bell, slam buy at market. Do not care about price, want out. What happens? Everyone hitting same button, same microsecond. Who is selling? Nobody. Arbitrage bots offline from hack, mining companies withholding supply, smelling blood, dealers under maintenance, wall of buy orders colliding with vacuum of sell orders. Price must jump vertically to level where someone finally sells. In this broken market, that might be 120, 140 or higher. We will see vertical green candlestick looking like software error. But it will be most honest price discovery in 50 years. However, darker scenario lurks, force majeure. If CME genuinely cannot reconcile books, if Salt Typhoon breach corrupted ownership records where they cannot determine who owns which bars, they possess nuclear option. Declare force majeure event. Suspend trading. Force every contract holder to accept cash settlement. Announce we cannot deliver gold. Here is check for Friday closing price. Attempt to pay $90 for silver trading at 130 in Shanghai. Ultimate rug pull. Defaults futures market without calling it default. Eliminates short squeeze by changing rules. If this happens Monday, if you see trading halted or cash settlement only, do not celebrate the check. That check is confession that paper market catastrophically failed. Contract was never legitimate claim on metal, was claim on broken promise. And if they force cash settlement, what will people do with fiat currency? Panic. Sprint to physical market to purchase actual bars. But physical market already empty, so street price of tangible metal will completely detach from settled price of broken exchange. World where CME price frozen at 90, but you cannot purchase real silver for less than 200. Bifurcated reality. This Monday chaos is inevitable consequence of the hack. Whether genuine or false flag is irrelevant, result identical. Trust shattered. Bridge burned. Global market now collection of warring islands. Monday, paper island inhabitants attempt escape to physical island, discover boats burned and ports closed. When you see Monday headlines blaming extreme volatility on cyber instability, translate. Means the run started. Short sellers trapped with no exit. Price attempting to find new equilibrium where paper no longer accepted as legitimate substitute for metal. $283 spread will not close by United States price gradually drifting upward. Will close by United States price exploding vertically to match reality. Or United States market will simply cease functioning entirely, and we will all quote Shanghai price from now on. This brings us to final verdict. We have examined the evidence. Dark data, impossible spread. Hong Kong lockdown, looming Monday chaos. What do? How survive cyber financial war? You do not fight it with code, you fight it with atoms. So here's the verdict. We have stared into void of dark data. Analyzed $283 spread, defying every law of mathematics and market mechanics. Witnessed digital iron curtain descend over Hong Kong, prepared for violent repricing approaching when sun rises Monday morning. But now we eliminate noise and confront terrifying reality of what this hack represents for you as individual investor protecting wealth and collapsing system. Understand that in modern finance, cyber attack is ultimate get-out-of-jail-free card for bankrupt institution. Bank runs out of money under normal circumstances, must declare bankruptcy. Messy, public, congressional hearings. People go to prison. But bank gets hacked, suffers critical infrastructure event attributed to foreign adversary like Salt Typhoon, suddenly not incompetent. Victims, freezing withdrawals not default, prudent safety measure. We have your money, promise we do, just cannot allow access because need to scrub servers for Chinese malware. Might take week, month, year. This is what we witnessed today. Technical issues at CME, not glitch, shield. Maintenance in Hong Kong, not updates. Lock. Using cyber warfare narrative to implement capital controls without legislation. Freezing emergency exits because a theater on fire without enough extinguishers. $283 spread is smoke billowing from underneath door. If you hold paper silver ETF, unallocated pool account, futures contract, you're in danger zone. Clutching claim ticket for coat check that burned down. When force majeure hits, when system admits metal is not there and never was, claim ticket worthless. Best case, they pay out in rapidly depreciating fiat, while actual metal trades at premium you cannot access. Lesson of this weekend, brutal but simple. If you cannot hold it in your hand, you do not own it. If counterparty stands between you and wealth, that counterparty is now single point of failure. Hack-proved digital ledgers can be erased, manipulated, switched off, but you cannot hack physical silver coin in your safe. Cannot erase gold bar with code. Cannot turn off buy button on metal existing in three-dimensional reality. This is why spread exists. Market pricing counterparty risk, telling you ounce of gold in your hand in Mumbai worth $283, more than promise of gold in New York vault. Market screaming exit the system. begging you convert digital illusions into physical reality before cyber lockdown becomes permanent. Entering era of systemic partition. West going dark, East locking down, liquidity vanishing. Monday, price attempting to find truth. Truth will be expensive. Truth is not enough metal exists to honor all paper promises made. Hack did not create shortage. Hack revealed it. Do not be distracted by salt typhoon headlines. Do not get lost in technical jargon of reporting errors and system maintenance. Focus on signal beneath noise. Signal is vault is empty. Exits are closing. Only safe harbor is one you build yourself with physical metal in your own possession. This is the Asian guy. The data is dark. The spread is real. The verdict is in. Get your metal out of the system before the system locks you out permanently. It is over.